Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
So Lauren, I thought we would do maybe a multi-segment series about stock market corrections, since that's the topic in vogue right now.
Right.
I thought the first thing I'd do is just maybe look at the mathematics of stock market corrections and how often they've occurred in history.
Okay.
And then we can maybe talk about what to do during a market correction, if that's okay with you. So this is some statistics from a person named John Prespo, who's called the Dow Jones Index Maven. So he's kind of focusing on the Dow Jones Industrial Average, but he looks at corrections. He calls it a correction of a decline from peak to low of 10% or greater.
Okay.
Okay. And then if it goes above 20%, it's called a bear market.
Okay.
So that makes sense.
All right.
So since the end of World War II in 1945, there has been 27 corrections of 10% or more.
In the stock market?
Yeah, in the stock market, and then they've had 12 full-blown bear markets with losses of 20% or more.
Okay.
And some of the mathematics is this equates to one correction roughly every 20 months, but that doesn't mean that it always happens every 20 months.
Right,
It just
exactly.
means the average.
Right.
They're never evenly spaced out. The interesting thing is 25% of these corrections over the last 66 years occurred during the 1970s, which he called the golden age of market timers. Right.
Okay.
And then another 20% happened during the time period of 2000 to 2010.
Yep.
And then the average decline for these 27 episodes of the 10% or more have been a decline of 13.3%, and that's about exactly where we're at right now.
Yeah.
Through this current decline.
Right. That's where we are right now in terms of when we're filming this.
Right.
Where we'll be by the time you listen to it, we're not sure.
Exactly. Could be all different.
It could be different.
And I'll say the date, August 25th.
Okay.
And here's the interesting thing. To regain that temporary decline, it's taken an average of 71 days to play out, or just over 3 months.
Okay.
What's your take on that, the mathematics of?
That was very surprising to me. I thought that there had been a lot more corrections since World War II. Maybe, I'm not sure why I thought that. Maybe that's because when I look at market history, I usually go back to the Great Depression. Maybe there were a lot more then. I'm not sure, but I thought that's a surprisingly low number. I can see now why maybe people, when the recent stock market corrections had been happening, I just thought, geez, isn't this just normal?
Right.
Like, isn't this just kind of what always happens in the stock market? But now I see that actually it's more rare than maybe I had remembered it being. And certainly it hasn't been as common these last few years.
Right.
It was very common, like you said, through 2000 to 2010, and also through the 70s. But
Right.
in the last few years, I guess the truth is it hasn't been that common.
Right. And the takeaway right now, I guess, to maybe make people feel a little bit better about them, is that when you're looking at like the news headlines in the media, and you see the number of like the Dow drops this amount,
Right.
it looks like a really big number, but from a percentage point of view, it's not
Right.
all that unusual.
Yeah, because I can remember when the Dow was much smaller,
Right.
when it was a lower total amount. So yeah, the numbers just keep getting bigger, but that's inflation of a different sort.
Okay.
Not something to worry about.
Last but not least, there's nothing in here that says why, but is there any specific reason why these corrections occurred, do you believe, or is it just happens?
Oh, most of the time I think that if you want to come up with a reason, the best reason there is people just decided that the businesses were too expensive.
Right.
I mean, that's what stocks are, they're businesses. So when you buy into the stock market, you're buying into a giant basket of businesses, and price is always subjective. What a fair price is always somewhat subjective. And most of the time when there's a correction, it's because people's subjective opinion, people generally, the general population's subjective opinion of the prices of businesses just went down.
So at the end of this episode, corrections are going to continue to happen in the future. That's part of the deal, because there has to be a risk to get returned.
Yep.
And we will have a part 2 of this episode talking about maybe some ideas to how to deal or handle these type of corrections in the future. Thank you for watching this episode of Erickson TV, and we'll see you next time. Bye now.
See you next time.